Every investor dreams of finding the perfect strategy, the one that consistently beats the market, grows wealth faster than inflation, and protects you from painful losses during downturns. And usually, two approaches dominate this debate more than any others: buy and hold, which builds wealth slowly through patience, and swing trading, which focuses on catching short-term price movements for quicker gains. Both sides claim superiority. Both sides believe they generate better returns. But the real question is not which strategy sounds smarter, but which strategy actually succeeds in the real world. Because behind every chart you see and behind every trade you place, there are deeper forces at work. There is math shaping outcomes, psychology influencing decisions, and probabilities determining results. Once you understand these forces clearly, you will know exactly which approach aligns with your personal goals, your risk tolerance, and the financial future you're trying to build. Today, we break down the truth behind buy and hold versus swing trading, the strengths, weaknesses, hidden risks, and the kind of investor each strategy is built for. By the end, this debate will finally make sense at a level most investors never reach. 1. What buy and hold really means. Buy and hold is one of the simplest investment strategies ever created because you purchase high-quality, long-term assets and keep them for years with minimal intervention. The reason it works so consistently is that financial markets historically rise over long periods, even when they experience temporary crashes, corrections, and unpredictable volatility. Compounding quietly multiplies your money in the background, turning small contributions into surprisingly large amounts without you noticing the growth day by day. Long-term investors also avoid emotional trading mistakes because they are focused on decades rather than days. Another advantage is that buy and hold lets you capture the strongest bull market phases that often happen unexpectedly and extremely fast. Missing even a few of the market's best days can reduce your long-term returns dramatically, but staying invested ensures that you always participate in those explosive periods of growth. This strategy rewards patience and resilience because it encourages you to ignore short-term noise and commit to bigger financial outcomes. Investors who follow this path understand that the real power of wealth building comes from consistency rather than perfection. 2. What swing trading really means. Swing trading takes the opposite approach because it focuses on short-term movements that last anywhere from a few days to a few weeks. Traders study price action, chart patterns, and momentum shifts to identify opportunities where they can buy at lower levels and sell at higher ones repeatedly. People are attracted to this strategy because it feels more exciting and gives them a sense of active control over their results instead of waiting for long-term growth. It also offers the potential to profit even during sideways or unstable market conditions. But swing trading demands a level of skill and discipline that most beginners don't fully understand until they experience losses. The strategy requires constant monitoring of charts, the ability to handle rapid decision-making, and a strong emotional mindset that can tolerate frequent losses without panic. One poorly managed trade can erase multiple weeks of solid performance if risk control is not applied correctly. Many traders overestimate their abilities at the beginning and underestimate the psychological pressure that comes with actively timing markets. 3. The data. Which strategy actually wins over time? When analyzing historical market data from major indexes, it becomes extremely clear that long-term buy and hold tends to outperform most active traders. This happens not because swing trading is flawed, but because most people cannot execute it consistently enough to outperform the market. Frequent buying and selling introduces significantly higher taxes and trading costs, which slowly eat into short-term profits. Emotional decision-making becomes another expensive factor because fear, greed, and impatience often lead traders into unnecessary losses. Buy and hold avoids many of these obstacles because it eliminates constant decision-making and reduces the chances of mistiming major market movements. Studies repeatedly show that the majority of traders underperform the very markets they are trying to beat, simply because controlling emotions is harder than understanding charts. Long-term investing does not rely on perfect timing or precision. It relies on persistence, compounding, and staying invested through multiple cycles. Over decades, these advantages accumulate into powerful results that many active traders struggle to match. 4. The psychology behind both strategies. Buy and hold demands a mindset built on patience because markets will not always rise in a straight line. You must endure volatility without reacting emotionally, and you must consistently focus on long-term goals even when the short-term picture looks unstable. This psychological approach reduces stress because you are not constantly monitoring every market move. It creates a stable emotional environment where decision-making becomes smoother and more rational. Swing trading, on the other hand, requires a completely different psychological framework. Traders must handle frequent losing trades without letting frustration cloud their judgment. They need to manage fear during sudden price drops and control greed during winning streaks to avoid overconfidence. The ability to react quickly with discipline is critical because hesitation or emotional impulses can ruin potentially profitable trades. Many traders fail not because of poor strategies, but because they cannot maintain emotional stability over long periods. 5. Where buy and hold works best. Buy and hold performs exceptionally well in long-term assets that naturally grow with the economy. Index funds steadily capture broad market performance without requiring constant analysis. Blue-chip stocks provide stability and slow but reliable appreciation over time. Retirement accounts benefit tremendously from the combination of compounding and long investment horizons. ETFs and dividend-paying stocks add diversification and steady income along the way. This strategy is perfect for people who prefer a calm, low-stress approach to investing. It suits individuals with full-time jobs who don't have time to study markets every day. It benefits those who want stable financial growth rather than the emotional roller coaster of active trading. Most importantly, buy and hold provides peace of mind because you don't need to predict short-term movements to succeed. You simply participate in long-term economic progress. 6. Where swing trading works. Best swing trading is most effective during periods of strong market volatility, when price movements create clear opportunities. It works well when trends are visible and momentum is easier to follow. Traders who have the time to analyze charts daily or weekly can take advantage of frequent fluctuations. This strategy is ideal for people who enjoy studying patterns and technical setups because it relies heavily on visual analysis. Swing trading also fits investors who are comfortable with higher risk and understand that losses are a natural part of the process. Discipline is crucial because success depends on following a plan rather than reacting emotionally. With proper risk management, traders can generate attractive returns in shorter time frames. But it requires consistent practice, ongoing learning, and a willingness to treat trading like a serious skill instead of a casual hobby. 7. The hidden cost. Beginners don't consider many beginners compare these strategies only by looking at potential returns, but they overlook the hidden costs that impact long-term results. Swing trading demands constant research and monitoring, which consumes significant mental energy and time. The emotional pressure of frequent wins and losses can lead to burnout if not managed carefully. Higher taxation on short-term profits can reduce net returns even when trades seem successful on the surface. Buy and hold also has its drawbacks because price declines can last months or even years during difficult market cycles. The slow pace of growth can feel frustrating for investors who want faster results. However, these challenges are typically smaller compared to the intense demands of active trading. Understanding these hidden costs helps investors choose a strategy that aligns with their lifestyle and emotional capacity. 8. So, which strategy actually wins? For most people, buy and hold is the superior strategy because it requires less expertise, less time commitment, and less emotional involvement. It produces strong, long-term results without demanding constant analysis or perfect timing. However, swing trading can outperform for individuals who are disciplined, skilled, and prepared to study the markets consistently. It is a strategy that rewards mastery but punishes inconsistency. The real winner depends on the investor's personality rather than the strategy itself. If your goal is to build long-term wealth with stability and low stress, buy and hold is the clear choice. If you want a more active approach and are comfortable with risk, swing trading may be the right fit. Some people even combine both by using buy and hold as their foundation and swing trading with a smaller portion of their capital. The smartest investors choose the approach that matches their mindset, not the trend. If this breakdown helped you understand the deeper differences between buy and hold and swing trading, imagine the transformation when you commit to the strategy that truly suits your goals. Your financial confidence grows when you follow a plan that fits your personality. Your wealth builds faster when your decisions are driven by logic instead of emotional reactions. And your long-term success becomes inevitable when you choose consistency over confusion. If you found this video valuable, take a moment to support the channel. Hit the like button to help more viewers discover financial clarity. Subscribe for more videos that simplify complex investing topics and turn them into practical knowledge. And share this with someone who still feels confused about whether they should invest long-term or trade actively. Understanding the strategy is the first step toward winning the game. Let's build smarter, stronger, and more confident investors, starting right now.